Hello everyone, today we talk about Volue investing. What is Volue investing? Volue investing is an investment strategy that involves picking stocks that appear to be trending for less than their intrinsic or book value. Volue investors actively ferret out stocks they think the stock market is underestimating them, believes the market outliers to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. The overreaction offers an opportunity to profit by buying stores and discount price on sale. Warren Buffett is probably the best known value investor today, but there are many others, including Benjamin Graham, Buffett's professor and mentor, David Dobb, Charlie Munger, Christoph Brown, and other grammar students, and billionaire hedge fund messenger Seth Klarman. Okay, takeaways. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Value investors actively ferret out stocks they think the stock market is underestimating. Value investors use financial analysis, don't follow the herd, and are long-term investors of quality companies. Understand value investing. The basic concept behind everyday value investing is straightforward. If you know the true value of something, you can save a lot of money when you buy it on sale. Most folks would agree that whether you buy a new TV on sale or a full price, you're getting the same TV with the same screen size and picture quality. Stocks works in similar manner, meaning the company's stock price can change even when the company's value or valuation had remained the same. Stocks like TVs go through periods of higher and lower demand, leading to price fluctuations, but doesn't change the value you're getting for your money. Just like savvy shoppers would argue that it makes no sense to pay full price for a TV since TVs go on sale several times a year. Savvy value investors believe stocks work the same way. Of course, unlike TV stocks won't go on sale at predictable times of the year such as Black Friday, and their sales provide one adverse. Value investing is a process of doing detective work to find these secret sales on stock and buying them at a discount compared to how the market values them. In return for buying and holding these value stocks for a long term, investors can be rewarded handsomely. Intrinsic value and value investing. In the stock market, the equivalent of a stock being cheap or discounted is when its shares are undervalued. Value investors hope to profit from shares they perceive to be deeply discounted. Investors use various metrics to attempt to find the valuations or intrinsic value of a stock. Intrinsic value is a combination of using financial analysis such as studying companies' financial performance, revenue, earnings, cash flow, and profit, as well as fundamental factors, including the company brand, business model, target market, and competitive advantage. Some metrics used to value a company stock include this price to book, or book value, which measures the value of a company's asset and compares them to the stock price. If the price is lower than the value of the asset, the stock is undervalued, assuming the company isn't in financial hardship. Price to earnings, which shows the company track record for earnings to determine if the stock price is not reflecting all of the earnings, is undervalued. Free cash flow, which is the cash generated from a company's revenue or operations after the cost of expeditions have been subtract free cash following the cash remaining after experience have been paid, including operating expense and the large purchase called capital examinations, which is a purchase of asset like equipment or upgrading a manufacturing plant. If a company is generating free cash flow, it will have money left over to invest in the future of the business, pay off debt, pay dividends or rewards to shareholders, and issue share buybacks. Of course, there are many other metrics used in the analysis, including analyzing debt, equality, sales, and revenue growth. After reviewing these metrics, the Volue investors can decide to purchase shares in the competitive Volue, the stock's current price with its company intrinsic worth is attractive enough, margin or safety. Volue investors require some room for error in their estimations of Volue, and they often set their own margin of strategy based on their particular risk tolerance. The margin of safety principle, one of the keys to successfully investing, is based on the premise that buying stocks and bargain price gives you a better chance to earn profit later when you sell them. The margin of safety also makes less likely to lose money if the stock doesn't perform as you had expected. Volue investors use the same sort of reasoning. If a stock is worth $100 and you buy it for $66, you will make a profit of $34 simply by waiting for the stock's price to list to the $100 true Volue. On top of that, the company might grow to become more valuable, giving you a chance to make even more money. If the stock's price rises to $110, you will make $44 since you bought the stocks on sale. If you had purchased it at its full price of $100, you would only make a $10 profit. Markets are not efficient. Volue investors don't believe in the efficient market hypothesis, which says that stock prices already take all information about the company into account, so their price always reflects their Volue. Instead, Volue investors believe that stocks may be over or underpriced for a variety of reasons. For example, a stock might be underpriced because the company is performing poorly and investors are panicking and selling, as was the case during the Great Recession. Or a stock might be overpriced because investors have gotten too excited about an unproven new technology. Psychological biases can push a stock price up or down based on news, such as disappointing or unexpected earnings, unexamined product resale, or litigation. Stocks may also be undervalued because they trade under the radar, meaning they are inadequately covered by analysts and the media. Fact, Benjamin Graham, the father of Volue investments, only bought stocks when they were priced at 2/3 or less of their intrinsic value. This was a margin of safety he felt was necessary to earn the best returns while minimizing investors' downside. Today we talked about Volue investor. For me, it's interesting to decide. Thank you for your attention and goodbye.